Market is, at least for the moment today, taking some comfort in what we heard from the president and Dr. Fauci moments ago. No more lockdowns, no new ones, at least at the time being. No more travel restrictions, and at least some level of optimism about vaccine efficacy.
Absolutely. I think that it's certainly, as time goes on, we're going to hear more data points. And we've even heard some suggesting that perhaps the degree of overall illness is not as great with this new variant, but we just don't know all those details just yet. But I think it's really important to maintain a diversified portfolio during times like this. We are similarly positioned to Jim in that we have not made any changes. We're maintaining an overweight to equity. But I think if you look within your equity portfolio, it's important to have exposure to both growth names, large cap tech names in particular. Those are, in this market, certainly regarded as being safe. They're what works every time there's been a global growth scare. And then have exposure to some cyclical reopening stocks as well, because I think that really will be the ultimate driver of the market if we look out over the next 6 to 9 months, if and when we do truly begin to reopen. So I think it's important to have exposure to both of those categories within a portfolio, knowing that they're probably not going to work at exactly the same time, and that's okay. It's part of having a diversified allocation.
The other point, Joe, is that, I wonder if stocks are more vulnerable today, given the fact that we've had this melt up going into this news and some calls for a correction being imminent, whether it was a technical call from Fundstrat or others suggesting that we were going to have some sort of pullback before a year-end rally. I wonder how you think about that issue.
So I think that we are in the process of completing a extremely complicated but educational week for all of us. The viewers, what they could learn from this is, remember, heading into the news of Thanksgiving evening, we were questioning whether technology was the place to be. Last Monday, you had a significant reversal for both the S&P and the NASDAQ. We were questioning a lot of the holdings, in particular, for hyper-growth stocks on Tuesday and Wednesday. Now, today, and because of the news on Thursday evening, we love technology once again. So I think the lesson really is exactly what Brenda is talking about. It's take your debt-laden cyclicals and forget them. Take your hyper-growth technology stocks and forget them. Find an Adobe, find an Intuit, buy one of those, and at the same time, buy a JP Morgan, buy an American Express. Take a look at what you personally hold. Scott, I absolutely believe the street is underinvested in healthcare. Go find an Anthem, an AbbVie, and increase your exposure to healthcare. Because guess what? We're learning healthcare is the solution. Real estate exposure. My real estate exposure, it is not where it should be given the performance we've seen year to date. Look at a Public Storage. Look at a Prologis. Two names that I'm looking at. So I just look at the entirety of this week and I say, okay, it's really time to understand what your risk is in the market, because you've had two strategies, the growth strategy and the value strategy, absorbing a tremendous shock. And I'm not smart enough to know which one of those I should be concentrating in a particular direction based on what the outcome's going to be for Omicron, or if the Fed is or isn't going to taper fast enough.